Are you thinking about buying a rental property or want to know how to buy and how to calculate the income and expenses on a rental property? Is making a profit on a rental property important to you? How do you calculate profit? In this video, I'm going to show you how to calculate the ROI, which is the return on investment, and what is the significance of an ROI. You should know your ROI before you purchase the property. So before you invest $10,000 or $100,000 or $200,000 in a rental property, you should figure out, is this property going to be profitable to you in the first year, second year, third year? Maybe you are not profitable the first year, but how about the second, third, fourth, fifth year? So let's analyze and figure out how to calculate your ROI on a rental property or on an income property. Hi, I'm Mike Patel with First Team Real Estate right here in Anaheim Hills, California. So what is an ROI? What is return on investment? Basically, return on investment is your profit. Of course, if you're buying a rental property, you want profit, short-term profit and long-term profit. So the profit is made on the initial investment that you make as a percentage of how much you are paying for the property and how much down payment and cost are upfront to you. So in simple terms, ROI or profit is your net gain divided by your investment that you make. And how do you calculate net gain? Basically, your net gain is your income on the property. In this case, it would be your rental income minus your expenses. Expenses could be your mortgage payment, your property taxes, your insurance, your maintenance, and if you're paying any utilities, and if you're paying any management fee. So if you take your rental income minus all the expenses per month, that'll be your net monthly income. And then you divide that by your investment that you make. And that'll give you a percentage of your investment, usually anywhere from 4% to 10% to 15 to 20%. So let's look at an example so we can understand how the percentages work and how profitable you can be. I picked this random house from Zillow. It's for sale currently, and they're asking $399, but I will round it off to $400,000. This is a 5-bedroom, 2-bath house, and it's about 2,300 square feet. And let's assume that we are going to pay all cash for this property. So to calculate the ROI before you purchase the property, first we have to figure out how much is the rent on the property once you buy it. There may be rents on it right now. It may be a rental property right now, and you trying to buy it and take over as the second owner of the rental property. So there may be lower rents, and depending on the states where you are, there are restrictions on how much you can increase rents as you become a new owner. But in this case, let's assume that the income for this property is going to be $3,000 a month, which is a realistic rent for this type of property, this type of house in Phoenix, Arizona currently. So a $400,000 house, approximately 2,300 square feet house, today can fetch up to $3,000 a month. So if we take $3,000 a month, which is your monthly income, and if we subtract all the expenses, in this case, we don't have a mortgage, so there are no expenses. So your income, let's assume that you have property tax, you have insurance, you have utilities, all that comes out to about $400 a month. So if we have $3,000 a month income, annualized, that is $36,000 a month. And if we have $400 a month expenses on an average, which is $4,800 annualized, that gives you $31,200 per month in income. That's your net income. Earlier, I mentioned to you that we are going to buy this property all cash for $400,000. So we pay $400,000 up front. That is an expense. Remember, there are closing costs when you buy a property. Let's assume it's 2%. So in this case, it's $8,000. 400,000 times 2% is about $8,000 expense. And let's also assume that you spend $20,000 after you purchase the property. You're going to have to spend $20,000 in maybe new paint, new carpet, or fix whatever. So we're going to assume that the total cost is going to be $400,000 plus $8,000 in closing costs plus $20,000 in repairs, etc., which gives us a total of $428,000 in expenses. So now if we take our formula, ROI or profit is your net income divided by total investment. Our formula says that our net gain is $31,200 and our total expense was $428,000. So $31,200 divided by $428,000 gives you 7.28% of your ROI. So your profit the first year, based on your investment, is going to be 7.28%, which could be good, could not be good. On average in California, cap rates and ROI run around 4% to 5%. But in other states, Idaho, Omaha, other states, they run 8 to 10% average. So it just depends what your comfort zone is. Is 5% profit good, or is 15% better, or 20% better? That all depends on your personal location, the time of the market, why you buying, how long you're gonna keep the property, how much investment you're making. For each individual investor, the number of ROI, or the factor, the percentage of ROI is different. 5% could be good, 5% could be bad. In this case, it comes out at 7.28% for the first year. So it may be good, it may not be good. Remember, the second, third, fourth, fifth year, you did not invest any money. So every year, if your income stays 3,000, which it doesn't, it goes up on average of 2 to 4% every year on average. So your rental income every month is gonna gain more and more and more. So it could be in 4 years, could be $3,500 a month rent, and your expenses may rise substantially as well. So all of a sudden, instead of making $31,200 a month in 4 or 5 years, you might be making $36,000 a month in rent minus your expenses. And remember, that's your net profit. Because you paid cash, that all goes into your bank account. Hopefully you'll accumulate a lot of money, and in 12 or 13 years you will recoup all the money you invested. And in the meantime, you can invest the money that you receive every month into other properties, or wait 3 or 4 years, collect $100,000, buy another property, or just wait and buy a bigger property on lump sum. So now you would have 2 properties. You bought the one for $400,000, which is appreciating. You are getting tax benefits, you are getting depreciation, and then after 5 years, 10 years, you can buy another property. So now you have a second property. So it's good to know how to calculate. Let's look another factor of ROI. If you purchase a property, but it's not all cash. So in this example, we are going to calculate ROI, or your profit, on the same property, but assume that you're going to put 20% down and you're going to get a mortgage loan. And we're also going to assume that you're going to have a mortgage interest rate of 6.35%, and it's a 30-year fixed rate on the $400,000 property. Again, going back to the ROI, we need to figure out our net gain. We know what our mortgage payment is. We know our rental is, which is $3,000 a month. Our mortgage is $1,987 a month. And then we have expenses, I'm going to assume, of $250 a month. It is less than $400 a month in the cash example. The reason I did that is because we already figured the taxes, the property tax and insurance in the mortgage payments. So now you don't have to pay that separate. So that reduces from $400. I took out $150. So it brings to your total monthly expense annualized at $28,000 per year. And your annualized income is $36,000 a month. So if you take $36,000, take out your annualized expenses of $28,044, your net income annualized is $7,956 per year. Now that we have our net income of $7,956, if we divide that by our net investment, and what is our net investment? Well, we put 20% down on a $400,000, which is $80,000. We have closing cost. This time it's not going to be 2%, which would have been $8,000. Now that we have a loan, we have underwriting fees, we have processing fees, we have appraisal fees, we have additional expense. So I'm going to count our closing cost to be $10,000 instead of $8,000 because of all the expenses I mentioned. And then we have the same repair cost that we were going to do as a new owner, which was $20,000. So our total investment in this case, putting 20% down, is $80,000 plus $10,000 plus $20,000, which comes out to $110,000. So if we take $7,956, our annualized income, divide by our total expense annualized, which in this case is $110,000, our ROI comes out at 7.23% annualized. I hope you understand how this works, and hopefully you can buy a property that has 10% ROI or 15% ROI. We've seen properties, even in California, we've sold properties, not in this market, but 10 years ago, we've sold properties with 18-20% return. Of course, they say in real estate that you make money buying the property. The lower and the better deal you have buying, the better off you are. So to find great properties, you have to keep looking for properties, hook up with realtors in your neighborhood. They will look for properties, and when there's a good deal, you can buy properties which has a higher rate of return the first year and year over year. So it's great to find great deals, great pricing. But remember, ROI is one factor of how to become profitable. Remember that when you buy a property, whether it's all cash or with 10% down or 20% down or 30 or 40% down, you also have other factors working for you. One is that the biggest factor is what we call the OPM. OPM stands for other people's money. So when you buy a rental property, the mortgage payment in this case, which was 1987, you are not paying the mortgage, your tenant is paying your mortgage. So one, you're getting profit. Number two, your 30-year mortgage is being paid by your tenant. At the same time, every time your tenant pays your mortgage, you're building equity because you're reducing your principal every month. You're dropping your principal, so you're automatically building equity. But remember, two other things are happening. Every year that you wait, and because the way real estate works, it appreciates on average 2 to 5% depending on your location over the long term, over the 10, 20, 30 years, the property is appreciating 2 to 5%. So your $400,000 property on average is appreciating 2 to 5% every year. Your tenant is paying mortgage, so you're gaining principal every year. So you're building equity more every year. If you have a great accountant or if you consult an accountant, you will get tax benefits, obviously property tax write-off, interest write-off. You have a vacancy factor, which we did not calculate. I was trying to keep it simple, but you figure about 3 to 5% vacancy factor. You have maintenance cost. All those are tax deductible, but you also have depreciation costs. So when you file your tax returns, you have depreciation, and on top of that, you can also accelerate your depreciation. You can take your depreciation very fast in 7 years and get more tax write-offs. So buying a property is very profitable. I own properties myself. I've sold a lot of properties for my clients, and it's always been profitable. I've never seen a client of mine that has lost a property in the long term. Of course, some of them lost during the recession, but they bought it high and they were thinking short term and they got hit. But if you buy long term, if you buy right, you can always make money. Most millionaires in USA and throughout the world, 90% of them own real estate, and that's how they become rich. Hope you find a great ROI property. Please direct message me if I can refer you to a realtor who knows investments in your local neighborhood. And also please watch this video, which is very informative.